All right, this is our 30-minute expert webinar. We're going to talk about e-commerce growth limitations. I am Stephen Brown. I am COO of LedgerGurus. I'm also a co-owner of a direct-to-consumer brand. I do a lot of our advisory services here. With me, I have Lauren Maillard. She is our Director of Service Delivery. She also isn't just launching, she has launched our income tax practice, helped lead and build our sales tax practice, and is a former small business owner. We're going to dive right in. Lauren's going to be watching for questions. Feel free to ask questions in there. So with inventory businesses, faster growth requires more cash. When you think about it, it's really because you pay suppliers for inventory before getting paid. Inventory takes time to sell. Wholesale payments can take time to receive. And cash to grow can outpace cash from sales. So there is actually a mathematical limit to how fast you can grow. Part of that limit is your profits, right? So if you're self-funding growth, one of your constraining factors is your profit, because that is the fuel that allows you to buy inventory and wait for payments to come in. The other limiting factor is this very complex concept called the cash conversion cycle. So hang with me, because the cash conversion cycle can be a little bit confusing. In fact, when I learned about this in MBA school and went through, I remember getting done and saying, I never want to do this again. But it's a very important concept to understand. And I'm going to try and break it down in very simple terms without hopefully confusing you too much. So basically, you put cash out of your bank account and into the machine that is your business. And that usually goes into the form of inventory. So the one way that cash gets tied up is in inventory. So you go in and you make an order, and you have to make your initial down payment. And then maybe you make additional payments. And then eventually it comes across on a boat, or if you're lucky, or maybe you're manufacturing, you have to buy raw supplies, and then it goes and it sits on a shelf until it gets sold. But the cash doesn't come out then. Then there's this concept of days sales outstanding. Now, technically, this would include some of the payout timing, but we don't typically track payouts as accounts receivable. But usually the days sales outstanding is look at accounts receivable. So when you're looking at wholesale, you do an invoice, and then that invoice goes to accounts receivable, and then you wait to get paid on that. For a lot of wholesale accounts, that can be 30, 60, 90 days. We saw in peak COVID, some retailers were saying, we're only going to do 6-month payouts. And so even though you sold set inventory, that cycle continues to go on for however long it takes you to collect the cash from that sale. Now, there is one area where the cash can go in your favor. So if you can defer payments to your vendors, that shortens that cash conversion cycle. But the way you have to think about it is, the longer this cycle is, the more cash you need to keep the engine running, because the cash is getting tied up. Now, the nice thing is it comes out on the other end, you're usually going to have more cash than you put in, right? So you put in $1, depending on your gross margins, you may have, $2, $3 that come out on the other end. But in the meantime, you've got that money that gets tied up for however many days. Now, if you want to know how to calculate this, and it really sucks, like I said, I did this in MBA school, and I remember thinking, I never want to do this again. And then I got into LedgerGurus, and we started working with e-commerce customers, and I said, oh, this is really important. I got to dust off my brain and do it again. So here's the calculations. Essentially, these are a mathematical way of looking at these three components. One is looking at average inventory values divided by cost of goods sold, average accounts receivable divided by total revenue, average AP or accounts payable divided by COGS. And the result is, this is how many days are tied up. And usually when I talk to my customers about this, most of the time, if they're not doing wholesale, the majority, if not the entirety of that number, is in days inventory outstanding. The business I own, we have a supplier out of Italy. They're very slow. It can take months from order start to completion, and then it's usually a couple of weeks to sometimes a month or two from outbound shipment to receipt in our warehouse. So we have a very large cash conversion cycle, and it's really annoying.
Stephen, where are you calculating this?
Where am I calculating this?
Yeah.
Where am I getting the numbers for this, or where do I calculate this?
Is it in the Grow dashboard or do you have an Excel? And how
I,
are
I
you?
I can do it in Excel. I do with some of our customers. We talked about metrics last month. For some of our customers that work with us, work with me on kind of advanced advisory, I've got a way to automatically calculate this. It is a little bit intensive to go through these calculations. I'll just put it that way. Now, the reality is your cash conversion cycle may not be accurately calculated. And let me tell you why. If you're not tracking your inventory correctly, then your cost of goods sold and your inventory balances are wrong, and your days inventory outstanding will probably be wrong. This is probably the number one issue I see. It's like bad inventory management, bad inventory tracking equals inaccurate inventory accounting. And therefore, I can't give you a good days inventory outstanding. If you're not doing good timely invoicing and receivables management, you're not going to have good accounts receivable numbers, and therefore that will be hard to do the days sales outstanding. I see some people, they'll get a bill, they'll just pay it, they treat it like a cash expense. So you don't really have your days payable outstanding. The right way to do is to put it into your accounting software as a bill, and then you pay off said bill, and the accounting software will keep track of those balances. So these are reasons why you can't calculate your cash conversion cycle accurately. And the first one is the one I see with almost everybody, including customers we've worked with for a while, because they just can't get their inventory management dialed in. When I talk to a customer who doesn't have good data, we can estimate what that number is, and give us a ballpark range. But just want to if you go to calculate that right now and you're like, that doesn't feel right, it's probably because one of these three things is not being done accurately. Now, with that cash conversion cycle, I can come up with what's called a working capital intensity ratio. Basically, how much of my cash is tied up in working capital. Um, and different businesses have different working capital intensity. I haven't calculated it for LedgerGurus. We're a services-based business, but I would say this is near zero. I won't say it's zero, but it's near zero, meaning we don't have a lot of cash working capital requirements. We typically bill quickly, or sometimes we pre-bill, so it makes it that we have almost no working capital intensity. For inventory-based businesses, this is completely different. As you can see, I can have two $1 million businesses, and depending on their working capital intensity, they may have much larger requirements, which means I need to have that amount of money available to put into the machine to continue to grow. How do I calculate that? Go ahead, Lauren.
Sorry. I'm asking the easy questions for those of us who aren't accountants or who I'm representing the non-accountants here. Um, what is working capital? What does it represent?
Working capital represents the amount of cash that gets tied up in that machine, in that cash conversion cycle. It's cash that's not sitting in your bank account. It's cash that's sitting in inventory. It's cash that's it's basically getting consumed by the business to keep running. And in an inventory-based business, that's primarily getting tied up in inventory.
Inventory. Okay.
Now, this working capital intensity is just a ratio. We take that cash conversion cycle it's a days number, and if I wanted to take annualize it, I would just take the annual cash conversion cycle, divide it by 365. So that gives me a ratio of what percentage of my revenue is going to get tied up in working capital. And so I need to have that cash available to run my business. Not, that that cash goes out of my bank account, typically into inventory. And the more intense the working capital uh, the higher amount of money I need. So where does that money come from, right? Today we're talking about self-funded growth. In a couple of months, we're going to talk a little bit about debt. But essentially, I have to get that money from somewhere. I either have to build it up through profits, I have to inject it into the business. And the faster I grow, the more intense that number can be. So, well, not more intense. Let me restate my statement. The faster I grow, the more likely that I am going to exceed my working capital available. So the self-funded growth rate is very simple. If you can wrap your head around what I've said. So let me summarize it down so you don't have to think about all these calculations. I have cash from profits and I have a need for working capital. So basically, you divide how much your profit you generate, your profit margin, divided by your working capital intensity. And that's going to come up with your maximum growth rate. So, and this is all mathematical. The reality is a little bit different. I'll talk about that reality. Essentially, when you run that calculation, it says, this is how fast, this is the maximum growth rate I can accomplish on my own profits. I should put an asterisk in there because there are some nuances, and I'll talk about that in a few slides. Now, why is this important? A lot of people are like, hey, I've got profits, but I have no cash. Yeah, your cash got tied up in inventory. I have no profits and I have no cash and I'm taking debt. That's because you're growing faster than you can grow from your profits. And this is an important thing to understand because it also will dictate how much debt you need. This is another part I'm going to do here in a few months in our expert webinars to help you understand how this limitation, exceeding it, is going to drive a need for more debt. So let's give it an example. I have my $1 million business. My maximum self-funded growth rate is 14%. So I can get $140,000 in new revenue, get to $1.14 million. Any growth beyond that is going to need outside capital. And again, I should put an asterisk on this because there are some scenarios where you could be growing this fast, but still need some additional capital. But before we do that, let's talk about how I can improve my self-funded growth rate. There's essentially a couple key levers. One, can I speed up my cash? Can I reduce my days inventory outstanding or reduce days sales outstanding? Easier said than done, right? Like me and my partner at the business that we own, we're like, gosh, how do we speed up? One of the things that we're talking about is, should we start air freighting? Would the cost of air freight be lower than the cost, because we're growing faster than our self-funded growth rate, would it be lower than the cost of lending? We can shrink the amount of time that we need to manufacture because there's for us about a 1 to 2 month cycle once the product's done. So part of us is we're starting to think about maybe we air freight enough inventory to cover the shipment time, and we shrink that inventory cycle a little bit. So that's one of the things, the thought processes we're going through. It's really hard to tell your manufacturer, go faster, right? If you can negotiate terms with your suppliers, that also speeds up the cash cycle because you're deferring payment. Other things, so optimizing how much inventory you have, because there's another part of that equation. There's the time from purchase to getting it into the warehouse, but how long is it sitting on the warehouse shelf? Can I shrink that? The second way you can improve your self-funded growth rate is to improve your profit margin. Easier said than done in the last couple of years. We are getting squeezed. In fact, I had a conversation with my partner yesterday, and it's like Shopify is raising their rates on payments. Our supplier is increasing their prices for the first time in years. I'm trying to remember. There was one other thing. They weren't big, but they're little. We're like, all these little things start adding up, and so we're like, crap. That's more margin squeeze. As my margin gets squeezed, my ability to self-fund growth also gets squeezed. The third lever is to slow down payments. Now that to a certain degree is kind of what I was talking about earlier. Can I get better terms and defer how long I'm paying for my inventory, uh, so that I have more time to sell that said inventory. So that is the one lever, better terms. One thought process I came across last year. Oh, sorry, a little clicking problem. Um, Again, there's another analysis you could consider. If I increased my, um, if I went back to my supplier and said, "Hey, I'll pay a little bit higher unit price if you'll give me better terms." Um, Again, you want to do a cost analysis. Would higher unit prices be cheaper than lending? Now, again, I'm talking about self-funded growth here. I'm getting a little ahead of myself into a future webinar where we're going to talk about debt, but that's another strategy you could use to improve things. So in that case, you're actually decreasing your profit margin to increase the speed to speed up your cash. Now, what I've talked about is really a mathematical way of looking at things. Let's talk about some issues where cash should also be considered. Now, obviously, one is obvious. We're here to talk about self-funded growth. If you are like, I want to grow faster than a number, and I can tell you for a lot of people, that number, that self-funded growth rate is going to be a lot lower than you probably want it to be. Well, then you're going to have to figure out how to get additional cash into your business, either in form of investment, debt, or investment could be two parts: investment from outside parties, or you, the owner, put more cash into the business. This next one's really important. This is where the asterisk comes in, which is where is the what I've talked about is a mathematical way of looking at self-funded growth. The reality is seasonality can break that number to a certain degree. You might, because we're looking at annualized averages, but in the reality is let's say you're doing your build up for holiday season, uh, you will probably need more cash than your profits are creating. So again, when you're doing mathematical equations, that doesn't represent realities. Now, how much cash do you actually need for that seasonality? Well, to do this right, you would really need to do like a cash projection, a cash flow projection, and that will help you tease out the nuances of actual cash demands. Um, because there can be ebbs and flows where you need more working capital than the math would tell you over an average 12-month period. Another thing to consider is like, hey, I stumble on this incredible opportunity. The biggest thing I see here is wholesale. So you might be cruising along and thinking, hey, I can self-fund growth, and then you get a deal to go into Costco or Target or one of these big retailers. They can be incredibly cash intensive, because they can on two ways. They can require large inventory orders that you have to fulfill upon, and their payment terms are longer. So all of these things can break this mathematical limit that I've talked about. What I like to think about with this mathematical limit is it's a way to frame where to think about things at a quick and dirty way without going through and doing extensive cash flow forecasting. And it also helps me understand if I go higher than that number on a growth rate, I'm going to have to find additional capital. Although point two seasonality, probably gonna have to have some additional capital regardless. Again, this mathematical equation doesn't take into account seasonality. It doesn't take into account existing cash you may have to be able to use. So there's a lot of nuances when you go through this in detail. So what are the key takeaways? Well, the key takeaways is every business has a self-funded growth limit. And I don't think people typically think about this. but they really should because um, it explains why these businesses are such cash monsters. It's also one of those things, the faster you grow, the more cash you're going to need. And so you can easily get into a debt spiral, and bad debt can make things worse. So we're going to do a webinar on debt. We're going to do it in June just because we have some other things we want to cover. But in June, we're going to cover debt. And I'm going to talk a little bit about debt spirals. But this is a really important principle on this because when you exceed your self-funded growth limit, you are going to have to take on debt or investment. And if you're not careful, you can have bad debt, chasing bad debt to keep up with the cost of that capital. Growth consumes cash before profit arrives. This is logical if you take a step back and think about it. But I've tried to explain in simple terms how that is. Again, your limit is determined by two things, how profitable you are and how cash hungry your model is. Finally, knowing your number lets you plan, not react. And this is one of the biggest things we want for our customers. As they get better at accounting, we really want them to use their data intelligently. So again, I have put on in the chat, if you look into the chat, there is a link. I'm only going to make this link available to this audience, and I'm only going to keep it up for about 30 minutes after this webinar. If you would like to meet with me and talk through your self-funded growth limits, even if your accounting isn't where it needs to be, we can estimate what that is. I'm happy to do so, no cost, but only for those who are on this webinar live. So go into the link, you can book me, we'll have 30 minutes to talk. And that link's only going to be available for about 30 minutes after we wrap up. To conclude, we'll take some questions, but I also want to take note of next month's webinar. We are going to talk about a benchmark that we're producing for the first time, which is we're going to look at some 2025 trends that we're seeing with our customers, specifically revenue trends, profit trends, cost of goods trends. We're going to be looking at a number of trends. I'm going to be going over that with our Director of Growth, Stacy Walker, and we are going to talk about what we're seeing and what that tells us. So this should be a really interesting webinar. What questions do we have as we are coming to the end of this quick 30-minute period?
Stephen, how do you calculate capital intensity?
The working capital intensity, first you have to have your cash conversion cycle, and then you divide that number by 365.
Oh, okay.
So
I
really you go through this. This is a really painful thing to do by hand. And even like I've got a spreadsheet that I use to calculate it. It's intense. And then you just take that number and you come up with a ratio. Take that day's number divided by 365, and that represents how much working capital gets tied up into your business.
Do you have an idea of the average growth rate for e-commerce businesses? Like with the clients that you see most of the time? That's probably a good question for next month's webinar, right? But what do you?
Yeah, I don't know that we're going to get that in this first benchmark. I would say it's not uncommon to have a cash conversion cycle of 90 to 180 days. If you were to take that, let's just take let's split the difference and say that is, I'm just going to do the calculation. We'll just do the calculation real time. So if you have an 150-day cash conversion cycle, 41% of your revenue is going to get tied up in working capital. And so then if we wanted to say, hey, what is my self-funded growth rate? So we'll just round down. Say my working capital intensity is 40%. I see a lot of very low margins, let's say 5% net income, and then divide that by 0.4, 12%, right? If I were to move, let's say I have a 10% profit margin and a 40 0.4 working capital intensity, 25%, right? That is, I don't see a lot of, these days I don't see a lot of 10% profit margins.
Mhm.
So it's more likely the former, whatever that was, zero point 0.5 divided by zero point 0.4. Sorry, that should have been 0.05, 0.05, 5% profit margin divided by zero point 0.4 working capital intensity, 12%. That's a lot lower than most people want to grow. But I think that's probably a typical self-funded growth rate based on what I'm seeing. Other questions, Lauren?
How can how can accounting managers help with this? Because accounting managers, if you've got your year-end financials, they should be able to calculate this.
Yeah, I'm going to be rolling out a tool where they could use this. I'm just finishing it up, so we'll have a tool that if you're working with us that you could run through. And I'm looking at turning that tool into a web-based form that people could use as well.
What part of the cash conversion cycle have you been the most successful in improving with Sole Toscana?
Um, we haven't. It's been really hard. Cash conversion cycle is really hard. So right now, I think I told you we are looking at analyzing the ability to air freight things and see if that's going to be better. Although with the war in Iran, air
Mhm.
freight's getting really expensive. So we're looking at some trade-offs because we do exceed our cash conversion, our self-funded growth rate. Um, and so what I would do as I'm looking at some of these trade-off examples is if I'm exceeding that rate, I'm having to take debt, as I would say, what's the cost of debt versus the cost of maybe one of these other strategies? That's how I would look at it. Because at the end of the day, if it's, you know, let's say it's neutral on profit, but increases my or decreases my cash conversion cycle, that also is going to reduce my working capital requirements, which is net positive. So ideally, if even if it's neutral in terms of the cost offset, but I have a shorter cash conversion cycle, that's a positive thing. Because the cash conversion cycle at the other end of it is more money than I put in. So if I can shorten that, it's always going to be almost always going to be a positive thing.
How does your strategy going out for like the next 3 to 5 years or even beyond that kind of determine if you want to self-fund or if you want to take on debt?
I think for most people, what I see is most people want to grow, grow, grow. And I don't think they fully understand the implications of fast growth, which is why I'm really trying to educate on these concepts. We actually had a podcast that dropped yesterday, the e-commerce finance podcast, which was a really great episode with one of my favorite customers, not my favorite customer. I really love Matthew. I love all of my customers, but I love Matthew because he is self-funding growth. And he talks about how he does that. And he's doing that partly because he's very profitable. He's very lean on his inventory. He's willing to stock out. We went through very extensively how he's accomplishing this. And let me tell you, he has a very successful business. And it's growing decently fast. But so you can have growth, but you're going to have good profits, good profit margins. And Matthew's super disciplined. He scrutinizes everything. And I think it's allowed him to self-fund growth. So if you want kind of a companion conversation on this topic, go to the e-commerce finance podcast and listen to the latest episode where I had a conversation with Matthew from House of Joppa. It's really incredible what he's doing. I don't see this very often. I think he's showing an alternative path to how you can grow your business. Um, Growth is not always the answer, right? Growth can be stressful. Growth can be risky. And I think for these businesses, the one thing I take away is growth is going to create pressures on cash and probably on stress for you that you might not want to have.
Hmm.
Hope to see you next month. Thank you for joining this month.
Thanks, Stephen.